Let's bring in Ed Yardeni. He's the president of Yardeni Research. Welcome back. Why so now?
Well, by the way, welcome back from vacation. I hope you had a good one.
Thanks so much. I did. Thank you very much.
Sure. Look, the market's had a huge move here since it bottomed on June 16th. I don't think we're going to go back and retest that. I think sentiment was so sour, so negative, as negative as it was back in 2009. So I think you've already seen a lot of capitulation, a lot of exhaustion by those who wanted to sell. But on the other hand, we're approaching September, and September can be a tough month, and you can find plenty of reasons why it might be tough this time around. We know that the Fed is likely to increase the Fed funds rate by 75 basis points. At the end of this week, Powell will update his hawkishness. I think he's going to continue to be hawkish about inflation. I think the key number here coming up here is going to be the CPI in September on the 13th, and that will be for July. And I think it's going to be another good number. So I think we're in a consolidation pattern here for a while. I don't think it goes down a lot. I don't think it goes up a lot.
I mean, you mentioned that we were so oversold before. Sentiment was so negative, right? We were due.
Correct.
We were due for some kind of a bounce, in which I would say, okay, I totally would agree with you in that light. But then things got crazy, right? The market decided that Powell shifted when, in fact, he didn't. Yeah. I mean, I don't know how many Fed people had to come out after Powell and suggest that he wasn't.
They all walked it back.
They all walked it back.
Yeah.
So why is all of this a surprise now? And it also leads to the question of whether the move was even justified in the first place, at least part of it.
I think it was justified to the extent that pessimism was way overdone. I think what we're experiencing is what I would call a rolling recession, or on average a growth recession. We're just not growing very much. And I think the first half of the year, we're going to find out that it wasn't even a technical recession. I think there's going to be upward revisions on GDP, because we know that gross national income is a lot stronger than gross domestic income. And so I think we are going to see an improvement in the first half of the year. And for the second half of the year, I think we're looking at something like 1% growth and maybe 2.5% next year. So I think that this is the most anticipated recession of all times. And that, from a contrarian perspective, either means it's not going to happen or it's going to be very mild. And so I think it's going to be very mild.
Oh, so you'll stick with your soft landing call?
Yeah, absolutely.
Yeah. And you don't think earnings are going to be nearly as bad as some people now expect? I'm sure you heard part of the conversation we had already on the program. Yeah. You don't agree with that?
Well, it's not that I disagree with others. I have my own opinion. And maybe it's different from some of the others, but my opinion is that the mild recession will be associated with a flattening of earnings, looking at forward earnings at record high levels for quite some time, maybe for a couple of more quarters. And that's consistent with an economy going sideways and a stock market going sideways.
Appreciate it as always. Ed Yardeni, I'll talk to you soon.
My pleasure.
All right, you be well.